and you can take advantage. And just like the animals, just like nature, you know, the birds don't stay in the north in the wintertime because they know the north better than the south. They move south because the environment's better. And then, you know, 6 months later they move back to the north. And really what people need to understand, and you know, Dolph alluded to this earlier, is that you don't need to stay in the north in the freezing winter when the environment is better somewhere else and you can migrate your wealth somewhere else. And that really, that bottleneck, that mindset shift is the biggest mindset shift that needs to take place.
Terrific, thanks. I'm going to switch gears now for a minute and go back to Joy. Joy, how is crowdfunding and peer-to-peer affecting the financial markets now, and what do you see over the next 6 to 12 months?
So I think right now what's happening is it's not affecting it a whole lot, right? Like it's just kind of an outlier. You know, some deals are starting to get done through there, but it really hasn't created any sort of significant competition. We're really at the very kind of early stages of seeing what sort of impact this will make. I think in the future what we're going to see is more transactions, more of these specialized platforms launching. Within the peer-to-peer space, we're already kind of seeing, you know, with credit cards, it's making a bigger impact. They're further ahead than the crowdfunding markets are. So peer-to-peer platforms are competing directly with banks for credit cards. You know, the kind of the credit card customer. I've got a flyer in the mail last month from Lending Club, and it was basically a credit card consolidation flyer, right? That's something that a bank used to send me, or you know, banks send on a regular basis too. So that is eating into the financial markets. Crowdfunding right now, not so much. You know, you're not going to go to a financial advisor who will advise you on private offerings as well and get a crowdfunding, you know, them direct you towards crowdfunding because it's just too early. There's no fee share agreements that are, you know, real prevalent. It's very early. Once there's some proof of concept and once more deals get done and people exit out of them, then I think we're going to see a major shift starting to occur.
Candace, different view, same view?
So I guess on competition, I have been in the peer-to-peer lending space now for years, whether that be defending Prosper as an attorney or moving into owning my own platforms. And what I can say is, you know, one of the areas that I think that there's going to be a lot of competition is not with the banks, but it's down market. So think about all of the non-bankable people and businesses in the world. Think of all of the non-bankable people in the United States. These are people who are typically served by very high-cost, short-term options. And these options are very unattractive. It is so easy to pick these people off and to give them a better option, a cheaper option. And the crowd, by the way, has the appetite for lower yields than these high-cost short-term options. And so I think particularly in the peer-to-peer space, and particularly with my company at Dealstruck, we are competing down market. And we're competing with the merchant cash advances, with the payday lenders, with the factoring companies. That's where we see there being an opportunity in creating transparency, which the crowd brings, and creating lower prices because the crowd has an appetite for a lower yield. So that's one area where we really see there being an opportunity. The other thing that, though, when you think about where are crowdfunding platforms going to compete, we all keep talking about who serves the entrepreneur. What about who serves the investor? And that's an area that I don't think we're having enough conversation on. Okay, where is crowdfunding going to become a replacement for mutual funds? What's going to happen in the secondary market? I'm very interested in those topics, and I think those are the areas where we're going to see quite a bit of opportunity, and whether it be in alternative investments. You know, what we saw is of the several million accredited investors, I believe there have been 2 reports, one that came out from Goldman Sachs, that said that 24% of them will be investing in crowdfunding at some point in time in the next 5 years, whether it be directly or through an intermediary. And so this is going to become a new way to invest your money.
So in that regard, who do you think are the financial players, the large financial players that are going to try to get into this market?
Oh, that's a good question. I mean, you're already seeing some of the larger banks wanting to play a role through partnership, whether that be with, and again, I know the peer-to-peer space, but whether that be with Lending Club, with Prosper, with OnDeck, and so you're seeing the union banks, you're seeing some of these larger regional $2 billion in assets or more banks getting involved. We're also seeing hedge funds getting very actively involved in the space. We have a number of family offices and hedge funds who have gotten very active with us. as well as we know that they're very active with the other platforms in our space, and I think that that's only inevitably going to happen in the equity crowdfunding space as well.
I can add to that. I think that your comment about investors and solving for investors, I think that really is going to be the key point at which equity crowdfunding is going to really begin to work. And that is, you're really solving the problem for investors, being able to make better investment decisions and using the internet to essentially make investing smarter. In particular, one project that we're working on now, we'll be launching next year, is called One Mid-Market, and the idea is to create a secondary market for trading securities of privately held companies. The problem of investing in a privately held company is there's no liquidity, and you can tie your money up for many, many years until an exit or to an IPO that you see it back. So if you can solve the problem of giving an investor some ability to sell their shares in a secondary market, as Can's mentioned, I think that's going to be a key point. The other key point, I think, is going to be along your due diligence, where the internet and the crowdfunding platforms can really provide high quality due diligence on these investment situations.
Well, and so just to play off of that piece, that's one area where we can learn from peer-to-peer lending, because it has been around now for 5+ years. And I think what you're seeing between the platforms that will succeed and the platforms that will not are the platforms that can underwrite for risk and price appropriately. And I know that in crowdfunding for equity, that's going to be difficult to do because the Jobs Act doesn't allow for that yet, hence the need for a Jobs Act 2.0. But what I will say is that the platforms that are able to underwrite and keep their default risk low are the platforms that will succeed over time. And we see far too few intermediary platforms and technology platforms, marketplaces that can spend any time on building out their underwriting and analytics.
Great. I actually want to go to both Brett and Scott for a minute, because we talked about something. We've been talking about the financial markets and the players. And I want to take a step back, and I'm going to ask each of you, starting with you, Brett. Brett, give us, if you can, 2 minutes of specifics about your business model. Do you consider yourself a disruptor, and how are you a disruptor?
Well, good question. I would say that One Mid-Market, which is the new thing we're launching, I guess would be disruptive in the sense that we're creating an ability for investors to trade shares in existing investments. So I think that is going to be important. And disruptive, I guess, in the sense is that that really hasn't been possible before. You pretty much make an investment, and you sort of wait around and hope that it works. So we think that could lead to a sort of a new element. The other thing I would want to add, and taking off on Candace's comment, is that the models that work, I think, and where the internet really creates opportunity, is the notion of diversification and indexing. What we're seeing, I think, the models in the healthcare space that have the most promise are those that are starting to build indexes. So in other words, you're making your investment not on one investment or 2 investments or 5 investments. You need to be getting to 15 or 20 investments to really begin to to reduce your risk. And that's where I think some of the guys are doing some interesting stuff. So at $100,000, it's now going to go into $25,000 at $5,000 a piece, or $250,000 at $20,000. Whatever the number is. You've got to get scale, you've got to be diversified. And that's where the internet, I think, and crowdfunding has a great opportunity, because you can begin to package these indices. And so I think we're going to see a lot of success. You'll see a diabetes index, and people will actually buy a security that basically invests in 20 to 30 different diabetes deals. Because when you get into Series A's investments, you don't know which of these things are going to work. Some of them are going to work, but you just don't know which. So you need, portfolio theory says you've got to get to 15 or 20 investments before you really can reduce your risk.
Scott, it's your turn. You're just give us a minute or two on your business model, and is it disruptive with respect to the traditional real estate industry and financing a part component of the real estate industry?
Tucker spoke a lot about 20th century thinking versus 21st century thinking, and with all due respect, I think a lot of people in the crowdfunding space don't even necessarily understand what that necessarily means. 20th century thinking, if you take REITs or you take syndications, a syndication effectively raises capital up front. Their interests are not aligned, because their interest is to make as much money as quickly as possible, raise as much capital. They're not that interested in the investor long term and the success of the investor, because they earn the money up front. A fund generally earns 2 and 20. They earn 2% on an ongoing basis and 20% hurdle rate. Their interests are not aligned. Because at the end of the day, all that they want to do is get as much money under management and then live off the 2%. Whether the value goes up or down is actually not that important to them. So for me, 21st century is where your interests have to be aligned. If an investor comes and invests with us, we do not make 1 cent in fees until the investor has made their return. We only make a performance fee after a hurdle rate has been achieved. Our interests are aligned. You spoke about trust, transparency, and interest being aligned. They're the 3 core values upon which we built our entire business. Very much a blend between nature and technology's laws. And if you take that and you add to it the whole global aspect, you know, there was a report that came out about a month ago here in America. It was talking about the scope of real estate crowdfunding and how exciting it is. And the fact that a company in San Francisco, a developer in San Francisco, used to go along to San Francisco investors, and then he used to go along to San Francisco banks to do a development in San Francisco. And now with the advent of crowdfunding, he can get a New York investor. And I sat in South Africa and I went, dude, you're missing it completely. Because not only can you get an investor in Singapore, in New York, you can get one in Singapore, South Africa, and Sao Paulo. And that for me is the absolute most important thing. But to come back to what Candace and Brett have said, it's going to come back to the people that know what they're doing. It's going to come back to experience. It's going to come back to due diligence. And to be honest, whether that's done on an Excel spreadsheet or some clever IT technology platform, it's irrelevant. You either know how to analyze a good deal or you don't.
Do you see the better opportunities in commercial or residential, or are you indifferent?
I would challenge people in this room. You don't invest in property, you invest in people. And so it's a residential opportunity in one area, it might be fantastic depending on the partner I'm investing with. A commercial opportunity in another area. The whole purpose and the beauty about real estate is that you've got to be niche. But it's got to be a blend between niche, where there's good opportunities, it's got to be based on a quality partner with track record and experience, and it's got to be scalable. I don't see the point of building a building here in Manhattan as a once-off attempt. In fact, I just came from a meeting this morning where they want to do that. It's stupid, because you're not going to get the benefit of learning. What we like to do is do the same thing over and over and over again. And so I wouldn't get caught up in whether it's residential or commercial. I wouldn't get caught up in whether it's North America or Australia. It's irrelevant. Where's your wealth going to get the best return? And where it's going to be the safest, we call it wealth preservation.
So that's a nice segue for me to lead back to Joy. And Joy, who do you see, and who does your firm see as having the most success in the industry right now? And are those the same people who are going to be successful 6 months to a year out, or let's call it a year to 2 years out?
So I think there's a couple people, the established players who have done, who have kind of proved their concept. EquityNet, for example, they've raised 230 angel list. They're pretty established. Microventures, they've done a lot of deal flow. Kind of those established players who have a track record, who Microventures, for example, they crowdfunded Twitter actually on Second Market, so they're purchasing stuff on Second Market. They've got big names, they've got kind of, really attractive type deals that they're working with that have a lot of name recognition to them. So those types of players who have really gotten out there and established a footprint and done some deals and have some traction and are continuing that velocity and being very visible, I think as long as they continue this trajectory and don't mess up, they're probably going to continue to lead the market. There's a couple different types of crowdfunding. There's the bulletin board model where anybody can post a deal. So Angels List, EquityNet is following that model. And then there's the very curated model where people are doing Reg D transactions on the platforms. And they're curating the platform, they're doing the deal, they're taking a position in the deal typically. I think the players who are specializing and doing really high quality deal flow will also be successful in that market.
Candace, how about you?
Well, DealStruck is clearly going to be successful because we
That's
offer
a softball.
highly curated deals and we underwrite those deals in advance. But I will tell you that I can't tell you who's going to be successful in the equity space because we honestly don't know yet. I think it's far too early, and you're not seeing crowdfunded equity deals yet, not really. I mean, we've seen $10 billion worth of transactions or of funds raised through just the ban on general solicitation. That's out of $300 billion that's been raised since September of last year in the traditional offering. So it's not, we don't have a ton of traction yet to know who the players are going to be in the equity space. What I do think though is, and I mentioned this before, is the players who actually hire people who understand finance are going to be the players who I think ultimately win. Whether that be on equity, a debt, or bonds, debentures, whatever in between, and whether that be real estate, healthcare, or any other niche. If you are a technologist, that's simply not going to be enough. This is a highly regulated space. This is a space that has a lot of hurdles at the state and federal level. And I think that it takes some grown-ups in the room, quite honestly, to make a successful platform.
So in a way, it's what Scott was saying. It's the people, it's not the necessarily.
It's not just the people, you know, I've invested in deals and I've raised money from investors, and it's not just, I really like this person, they've got the fire in the belly and they're gonna work their ass off. That's not enough in this space. You have to know what you're talking about. And, you know, and I'll admit that I was in the beginning a person who didn't know what I was talking about. And that's something that I think that, you know, as each of you in the room are looking at which platforms you're going to invest your money with, whether it be with the platform or with the deals, make sure that the team understands the financial products that they're working with.
Terrific.
Can I back Candace up there? I mean, from our perspective, I mean, we've got 229 years of international real estate experience just in our investment committee. And my purpose there is that I'm actually the youngest person on the committee. You know, really in property, if you haven't been playing the game for 25, 30 years, you haven't seen it all and you don't know what to do. And to be honest, the time when it's going to really get bad is when the market turns on you.
Yeah.
Because that's when the really, if you take the global financial crisis, and I have the privilege of dealing with some of the best people internationally, most people went bankrupt. But those people that actually knew what they were doing, they succeeded. I mean, in Australia, in 2009, we invested in Australia with $4 million. In 4.5 years, that was $40 million. We listed the company. Today, you can go on, it's on the Australian Stock Exchange, $200 million. And that is while America was having the worst real estate crisis it's ever had.
Well, and I think too that it's going to be important not only to underwrite risk ahead of time, but to know teams who know how to do workouts, who know how to do